Okay, it looks like attending numbers are fairly stable now. So thank you again, everyone, for joining us this afternoon for the latest IRU, Apply and TI webinar on the European road freight rate benchmarks for Q2 2024. We're very pleased to see you all again and to have an opportunity to talk you through the very latest trends and developments in terms of the European road freight market, and of course, looking particularly at pricing and developments now. And obviously, this webinar in the middle of the year over the summer is always an interesting opportunity to take stock of developments over the first 6 months and look ahead to the second half of the year ahead. I think there's more optimism generally in the road freight market now. That's what we hear from shippers and carriers, really, in terms of demand picking up and the market returning to healthier operating conditions. But with that, obviously, comes a challenge of capacity again, and that's sort of sets the tone for rate expectations for the period ahead, looking at those cost increases being passed on in a tighter supply environment. And again, so today we're going to be drilling into all of that. And we're also going to be looking at some of the supply side issues in a bit more detail, bringing you the latest from IRU on driver shortages, on tow price increases, and other significant regulatory changes which are affecting the market. Now, as ever, the presentation today will be about 30 minutes, and then we'll have a 10-minute Q&A session. So please do ask your questions on the Q&A tool via Zoom as the webinar goes on, and we will do our best to answer as many as we can at the end. We'll also, of course, be sending out a copy of the report and a recording of the webinar after this session, and Apply are also doing what they're calling a digital tote bag, where they're providing you with a few more details and goodies in relation to the report and webinar after the session. So you've got that to look forward to. So now I'll introduce myself and our panelists. So I am Michael Clover. I'm your host today. I'm TI's Head of Commercial Development. And Transport Intelligence, for those that don't know us, we're a provider of market research, intelligence, forecasts, and analysis for the road freight market. So if you need to know about how the market is changing and what the future looks like, please do come to us. We'll be very happy to discuss that with you. I'm also joined by my colleague, Nathaniel Donaldson, who's our data team lead and an economic analyst at Transport Intelligence, and who's responsible for a lot of the analysis and data that is presented in this report today. So thanks, Nathan, for joining us.
Hey, Michael. Hello.
I'm also joined by Romain Mouton, who is from IRU, and will be providing his insights for us today. Romain, could I ask you please just to introduce yourself and IRU to anyone who may not know the organization already?
Yes, hello, good afternoon, everyone. My name is Romain Mouton. I'm research manager in the strategic and market intelligence team in the IRU. IRU is a World Road Transport Organization. We are based in Geneva, and we represent the entire industry, bus, coach, truck, taxi, and drive the sustainable mobility of people and goods across the planet. I particularly work on tracking industry metrics and disseminating them to the world. I'm also the project manager of the Green Compact IRU Decarbonization project. It'll be a pleasure to be with you today.
Thank you, Romain. And just before I introduce Thomas, I must also just read our little disclaimer at the bottom here, which just says to remind you that all discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. And now, finally, I can introduce you to Thomas IRU, who is Chief Executive Officer at Apply. And again, Thomas, could you introduce yourself and Apply to anyone who doesn't know you already?
Yeah, hello, Michael. Hello, everybody. So Apply is a tech company dedicated to supply chain. We are providing digital services to freight forwarders and shippers. And one of the top services that we have today is mainly based on collecting data from shippers and from freight forwarders on all modes of transportation: air freight, ocean freight, and road transportation. And what we'll see today is dedicated to road transportation from direct invoices that we're collecting at Apply.
Thanks, Thomas. Yes, and obviously Apply responsible for all the rates data that we're actually reviewing today. And Thomas will just briefly explain the methodology for that next. But also just to bring to your attention that we will be running a poll asking you your views on rate development over the next quarter. So please be prepared to answer that in a few slides' time. All right, Thomas, could you just give us a bit more background on the methodology you used to gather the data?
Yeah, so it was the introduction. Let's say we do collect data We also have we provide a marketplace services, a kind of sourcing platform in which freight forwarders, shippers can be in contact with freight forwarders, and all these softwares that we have are collecting data, but what is important is that transactional data, in the sense that we are talking about real transports that happen at a specific time with all the characteristics of the transports. And this is what we are doing with a team of data specialists that is gathering data. And here we will have a look at all the index that you will see at FTL, full truckload data for general cargo with spots and contractual prices. We will have the split between the two, fuel included in the majority of time, and you will see sometimes that the fuel is excluded. And something that is important, that when you see in the graph a figure that is 100 or 200 something, it's usually an index, 100 base, it is written just in the source. And when you have the euro sign, it means that this is the price for, let's say, an average FTL general cargo that is going from this origin to this destination.
Thanks, Thomas. Yes, absolutely. So we'll turn to our first content slide here, and this one is the European road freight benchmark for which the report is named, looking at spot and contract rate development right across Europe, and giving you an overall picture of the development. And Nathan, can I ask you just to take us through the latest trend and what's driving this change?
Yeah, sure. Thank you, Michael. So what we're seeing here, this picture is really reflective of what we're seeing on many lanes. And obviously what you're seeing there is that we have an increase in the spot price. So the spot index is heading upwards, while the contract index is heading downwards. Now, just to make clear, we have seen the spot index just rise above the contract index here, but it doesn't mean that all spot prices are higher than contract prices. It means that the spot price relative to its base level at Q1 2017 is now higher than the same comparison for the contract index. But it does mean that we do still see that in multiple areas. So basically, we have a spot index which is heading upwards due to signs of increase in demand. So we've now got increase in demand pressure, long-awaited increase in demand pressure, especially from the consumer side. So we've seen that inflation has receded, wages have grown, and actually the wages have grown ahead of inflation recently, and as a result, we're seeing increased demand pressure. So if we look at the actual data, we see that the spot index has risen 3.5 points quarter on quarter. Now that's up to 127.7, and that's now up 0.8 points year on year. The contract index has fallen 1.3 points quarter on quarter to 127.1 points, and it's now down 0.7 points year on year. So if we want to look at now the drivers behind this, it's definitely a demand picture. So I think for quite a while we've been focusing on the supply side, the rise of costs that has affected things and push rates up. Now we're really looking at demand. So we look at generally first, if we go and look at the consumption, so euro area inflation has fallen to 2.6% recently, and that's now actually below the wage growth that we saw in Q1, which was 5.1%. So now, for the first time in a while, we have people with more money increasing discretionable incomes. Now, this has facilitated a retail demand growth. Eurostat data shows an increase of 0.3% quarter on quarter for Q2, based on available data. Now, that's also up 0.4% year on year, and it sits 4.5% higher than in 2019. So basically, we're seeing some recent short-term increased pressure on demand, especially from consumers. That's increased the pressure in the market. It's pushed up spot rates in the market at the moment. If we look at the contract rates, now they're actually heading downwards. Why is this? Well, actually, we see that generally, especially in industry activity still remains lower than it has been previous years versus kind of pre-pandemic levels. If we look at the actual Eurostat data, we see production volumes for the euro area are down 2.9% year on year, and now 2.7% 2019 levels. We are seeing some levels of growth. So we saw a 0.6% quarter on quarter growth from available data in Q2 2024. So we are seeing some upwards pressure, but notably Europe's absolute powerhouse and industry powerhouse, Germany, is still struggling. So whilst the euro area production volumes grew in the recent quarter, it fell 0.8% quarter on quarter for Germany, and the volumes are now 5.1% down year on year and 11.6% down versus 2019 levels. We did also see some smaller falls in France and Spain. However, Spanish production remains up year on year and is generally quite strong. But what does this mean for the road freight market? Well, newer contracts coming to renewal have lower volumes. They're demanding lower volumes in the contract market. It's reduced demand side pressure. We're also seeing less pressure from the cost side. So we're seeing that the short-term demand, especially led by consumption, is pushing the spot rates up, but the contract rates are now seeing lower levels of demand versus previous years, and they're heading downwards at a gradual level, really.
Mm. Yes, thanks, Nathan. And we'll just launch our poll now to see what your expectations are for rate development over the next quarter. So you should see the poll pop up on your screen, and please do participate. I think one other thing just to say about the developments and the trend that we've seen over the last year in the road freight market is that the sort of rate volatility compared to the prior few years has decreased. We've stabilized really, even though we're seeing ups and downs. There is a bit more stability in the market now. But expectations are that, as Nathan says, that demand side pressure will compound the supply side issues that we have and lead to increases again. And so that's our sort of expectation for the market ahead. But it'd be good to understand your viewpoints as well. Hope I haven't just prejudiced that too much while you're still filling out the poll. It looks as though we've got quite a good number of you who participated already, up to sort of 300 now. So just wait for the other sort of 40% of you or so to join in, and then we can do a bit of analysis. But looks like we're slowing down a bit. Okay. So I will close that poll, and we'll just present the answers for you now then, and we'll give a quick take on that once I share the results, which you should be able to see on your screen now. So you can see there's a bit of a trend there towards the slight increase there, or flat. What's your take on that, Thomas?
Yeah, it's interesting to see that, in the sense that the poll that we ran last quarter was more in favor of they will remain flat. It was also some were putting slight increase, but it was more in the middle. Now we can see from the result of your poll, and this is what we were talking just also previously, and that we will explain during the webinar, that there is a kind of pressure on demand that is starting to pick again, to start again. So it can shows indeed with some difficulties also on the offer side, with difficulties from the companies, the carriers that have troubles, and some carriers that are being bankrupt, and all the driver shortage part that we will talk about. My view is that the slight increase, stable / slight increase for the quarter to come, or the quarter to comes plural, is, I think, a good guess.
Yes. Fair enough. But thanks for that, Thomas. That brings us on to really on some of the supply side issues, because even though we can say demand is sort of driving the sort of current uptick we're expecting to see, it's important to remember also that the fact that those rates can be passed on or increased, and costs passed on, is all about the supply side as well, really. So we're going to start a few slides here on those issues, and Romain's going to start us off with diesel prices. If you'd give your view on these, Romain.
Yes, thank you, Michael. So between April and June, we have observed a reduction of diesel prices at the pump to reach 1.07 euro, 1.07 euro per liter on average in the EU. That's 11% reduction. It was the lowest level since summer 2023. This decrease was mainly driven by crude oil prices reduction. And after the rises seen in Q1 2024, crude oil prices have been falling since April due to concerns about global economic and oil demand growth. For industrial activity, and another mild winter reduced diesel consumption this year, particularly in Europe, where already a declining share of diesel car reducing consumption. Now, diesel prices increased afterwards, pushed by a rise of crude oil prices, with EU average diesel price reaching 1.14 euro per liter in July. crude oil prices have been increasing since early June due to the extension of voluntary cuts announced by OPEC+. And according to forecasts, crude oil prices will continue rising in the coming months, having the same effect on diesel prices at the pump. Crude oil prices will reach $89 per barrel in the second half of this year, and that's $5 more compared to the first semester. The rise will continue up to $91 per barrel in Q1 2025. Other crude oil producers are set to compensate OPEC plus production reduction, but it could lead to inventory withdrawals in the meantime due to a growth of global consumption, supporting the crude oil prices increase. And to end on diesel prices, the market is expecting to return to more normalcy during the second semester of 2025.
Thanks, Romain. Yes, so we've seen a sort of fall, but recently price going up again. If you look at the really recent data, so very interesting to see and good to understand where we're headed. And another projection really here as well. This time on the demand side, actually looking at volumes from IRU. So if you just take us through the outlook here as well, please.
Yes, Michael. So here the volume is given in ton kilometer and it's an index. And according to IRU forecast, road freight volumes in the EU will mildly improve this year in 2024. That's 0.4% growth compared to last year, reaching 1.91 trillion ton kilometers. And the reasons behind are a modest recovery of private consumption, having a 1.3% expecting growth this year compared to last year. Continued increases of wages and employment will sustain growth in disposable income in 2024, but private consumption expansion will be limited due to a further pickup in the saving rate. Now, growth of road freight demand is expecting to be stronger next year with an increase of 1.6% versus 2024, thanks to a stronger growth of private consumption. And as a result, road freight volume will reach 1.94 trillion ton kilometers, exceeding 2022 levels. Continuous decline of inflation will support further growth of real disposable income, with real wages expecting to recover their 2021 levels. However, big uncertainties remain. Any development relating to the two currently ongoing wars and high geopolitical tension will have an impact, positive or negative, on global trade and energy markets. And EU central banks may also postpone interest rate cuts until the decline in services inflation. On the other hand, a decline in savings rates could stimulate consumption growth.
Thanks, Romain. Yes, okay. So we'll move back on now to the supply side perspective, and in this case, we're looking at how the driver shortage is impacting companies, but in this case, quite interestingly, I think looking at different size organizations as well and how that impact maps onto them. So really interesting stuff. Could you just take us through it, please?
Yes, Michael. And as a reminder, 233,000 truck drivers' jobs were unfilled in Europe last year. And according to our driver shortage 2024 first results, 48% of European companies expect to face more difficulties to fill truck driver position next year. And indeed, over 1/3 of truck drivers are 55 years old or older and will retire in the next 10 years, while only 5% of truck drivers are below 25. And as I've just said before, road freight demand is expecting to improve next year. And if no action is taken to improve the attractiveness of the profession and or to increase driver productivity, the truck driver gap will increase in the coming years and potentially put upward pressure on driver costs. Small companies are the most impacted, with about half of them facing very severe difficulties, while bigger companies are the least impacting. Given the low profit margin of the road freight operators, big trucking companies have more means to attract and retain drivers, such as creating programs to cover driver license and qualification costs, offering drivers flexible career paths, or providing comfortable cabins or equipment, as well as resting facilities at depots. Just for you to know, the survey is not closed yet, and I will share in a few minutes the link to if you are interested to answer it.
Thanks, Romain. Yeah, really interesting. And looking at that different effect on different sized organizations is really important. When think back to what Thomas was saying earlier about supply side issues, obviously with the smaller companies not being able to source drivers, that is going to have a big impact on subcontracting and actually being able to fulfill volumes. So yeah, really interesting to see. Okay, and then finally, the last slide on the supply side we've got is on the ongoing tolling developments. So if you could bring us up to speed with the latest changes, that would be great.
Yes, and let me start with the U-vignette, so the CO2 component on the toll. Germany continues to implement the directive on more vehicles, with trucks between 3.5 and 7.5 tons now facing fees since July. Recently, Sweden shared its plan for the introduction of the CO2 component in its tolling scheme starting January of next year, with trucks above 12 tons. It will be extended to all trucks in March 2027. The toll increase is still unknown, but it is said to be first limited. Denmark is planned to follow as well in 2025 and the Netherlands in 2026, but we don't have clear figures yet. For the other country, in May, 16 member states received a formal notice from the EU Commission to move on the implementation of the Eurovignette directive. So changes might then come soon for them, such as in Poland and in Spain. The impacts of Eurovignette are already felt in Germany, which implemented the CO2 component in last December, with abnormal spikes of bankruptcies for transport and storage companies, with level 20% greater than usual in March. Domestic mileage fell by 5% the same month, and foreign mileage by 4%. Additionally, 3 countries announced changes of toll fees, which are not related to the Eurovignette. Slovenia toll fees increased mid-July by 7% for heavy-duty vehicles. Fees also increased in Belgium since July, with the implementation of an inflation correction. And Hungary will implement the same system in January 2025, expected to lead to another rise.
Great, thanks, Romain. And I think one of the big questions that we'll try and answer when we're looking at the rates now is as well, can we see whether those toll increases are being passed on? So we'll move on to our first sort of individual lane now. And Thomas, you're going to take us through the France-Spain lane.
Yes, so here we have the slide of France versus Spain. I mean, France to Spain and Spain to France, where we have a representative track from with the distance between, I think here it's Paris to Madrid exactly. So this is the, let's say, average cost for a general cargo full truckload between these two main regions, with the exact distance that there is between Madrid and Paris. And we are following the exact representative track every quarter. What we see over there, so for the one who are following the webinar every quarter, we already talked about this point, but Spain after the COVID was hit very hard by the inflation, but they reached to fight it better than other countries. And right now, and for the past quarter, Spain has been the top class, the best in class, let's say, in Europe, with a very high growth in terms of GDP and consumption, what was not the case for other countries, and especially for France, where the consumption was low, which showed directly here the divergence between rates from Madrid to Paris that are in red and light red, and from Paris to Madrid on the other direction. Basically, the demand from France of Spanish good was low, putting pressure downward on the rates, while the reverse, where the industrial and the consumption, the industrial growth and the growth in consumption of Spain was very, very strong, and showing this increase of rates. What we can for the following quarters to come, or at least the one that will come, what we see right now, and I'm directly quoting what we have put in the report, is that for the first time since some times now, we have seen an increase of consumer demand in France, an increase of 2.4%. So while it was the decreasing for the past quarters, now we have the demand that start to increase again. This is the consumer demand. In terms of industrial consumption, industrial goods, this is still going down. This is still at a lower rate. If we are looking at Spain right now, the consumer demand is having a resurgence of plus 3.7% quarter from quarter. So this is huge. And also, if we are looking at the consumer spending money in FMCG markets, this is plus 4.8% on a year on year. So this is just showing that after a high period of inflation, it seems that consumers and the households, the classic households, are adjusting to the high inflation and are starting to consume again and to consume more than they were doing in the past quarter. So it can shows a start of demand that is picking, while it's not the case since in the industrial productions in both countries, but it's still a good sign to see the demand starting to pick again.
Yes. So we may see that gap close in the coming quarters as
this is what is expected indeed. Yeah.
Okay, and we'll move on now to another high volume lane with France, Germany, and Nathan's going to talk us through the trend here.
Yeah, thank you, Michael. So on this market, if you look at on this route, if we look at the contract rates first of all, we see a general fall. So they're down quarter on quarter, 1.4% on the head haul towards Lille, and then up in the opposite direction, they're down 2.3% quarter on quarter on the back haul towards Duisburg. If we look at the spot market now, after a big drop in the previous quarter, they've rebounded somewhat above the level 6 months ago when we're looking towards Lille. So that's thanks to a 6.7% increase quarter on quarter. On the back haul, the spot fell 0.5% quarter on quarter towards Duisburg. So an interesting story here is if we look at the contract versus the spot market on the head haul, spot rates are now 7.3% more expensive than the contract. So that's a big contrast to where they were the previous quarter, where they were 0.9% cheaper. So spot rates were 0.9% cheaper than contract. We look over on the back haul markets are actually diverging. So the spot market is now 16.6% more expensive than the contract. And that's as a result of falling contract rates and rather stable spot rates. Look at the demand pressures here. It's basically quite steady, signs of quite steady consumption demand from France into Lille for consumption, and production is slightly falling, but is more positive than Germany is. So it meant that from a more negative view last quarter, we've seen now a more positive view has allowed the rates to rebound just above the level that they were 6 months ago for the spot market. However, industrial production, as I mentioned, falling quarter on quarter in France is meaning that newer contracts are adding less pressure to the contract market on the head haul. On the back haul, we have consumption, which is rather stable. It's no longer being eroded. German consumers are no longer being eroded in terms of their spending, and total German consumption was up 1.2% quarter on quarter, and that's based on available quarterly data from the statist. If we look at the contract market now, as that's fallen, actually, the rates on the contract market to Duisburg have fallen 6.4% over the previous 6 months, and now 11.3% below their peak in quarter 4 2022. This is a result of lower German production, lower volumes coming on new tenders, less pressure on the market, and we look at those longer contracts. So it's likely that it's still got some more to drop, as we've seen that in the most recent quarter, the production is still falling in Germany. So generally, we're seeing on this that there's still some falling that is possible, still some falls possible as we look at the contract rates. The spot rates are edging upwards, however, not as much towards Germany as Germany's still struggling a little bit all round.
Thanks, Nathan. So in that data set, we don't really see the toll increase being carried over or passed on, but obviously lots of demand side factors influencing that as well. We move on to Poland, Germany now, and we may see a slightly different trend with some more increases in the last couple of quarters here, and Romain's going to just talk us through this lane.
Yes, Michael. On the head haul from Warsaw to Duisburg, contract rates increased 2% compared to last quarter. It's a negligible margin of 0.3% year on year. The spot rate the spot rate rose to 1,716 euro, rising slightly by 1.3% quarter-on-quarter and 6% year-on-year. On the backhaul from Dresburg to Warsaw, contract rates rose marginally by 1.3% quarter-on-quarter, rising similarly by 1.4% year-on-year. For the spot rate, it rose sharply by 10.6% quarter-on-quarter. There has been a recovery in the Polish production sector, although mild. We observed a decline in industrial production of 1.7% year-on-year in May, and Polish retail sales increased in May by 5% year-on-year, maintaining the trend from the first quarter of this year. Car sales continue to grow at strong levels, with 13% more registrations than in Q1. And as Nathan has already said, German industrial production fell in May, signaling that the manufacturing sector in Europe's powerhouse is not recovering in the short term. Moreover, German industrial orders dropped for the fifth consecutive month, 1.6% in May versus April. This could have further downward pressure on contract rates on this route. Operating costs are still rising in Poland, most significantly for labor and insurance costs, with an average increase of 4.7% quarter-on-quarter. Since the cost pressures are still prevalent on the head haul of this route, we expect them to have an upward pressure on both spot and contract rates in the coming months. Finally, strong wage growth in Germany might nudge a recovery in household consumption. However, the economy lackluster performance suggests that it's unlikely that we observe significant rate hikes this year along these routes, especially when considering Polish recovery being slow and steady.
Okay, thank you, Romain. Well, we'll now move on to the next lane, which actually is looking at sort of demand on lanes to and from major ports. Nathan, I might have to ask you to be quite quick with these next two, just because we're already over time. But if you just take us through it quickly, that would be great.
Sure. So generally, the story is that we're seeing export lanes falling. So we're seeing a big fall in the export contract, slight increase in the export spot. The import lanes, however, are rising. So we're seeing growth in the import lanes. Generally, the story is that the European continent is demanding a larger volume of imported goods, and this is coming through the ports and it's adding pressure. So if we look at the demand side, we're seeing that generally, based on the Dutch Bureau of Economic Analysis, total volume imports is about 5.1% below the 2023 levels. However, if we zoom in and we look at the data, we see that on average it grew 0.4% in the first 4 months of the year. That's in contrast to minus 0.3% the first 4 months of 2023 and 0% in the first 4 months of 2022. So we're seeing that in the short term, we're seeing growth, some added demand side pressure. However, similar to what we've covered elsewhere, production is weak. The result is that we've got fewer exported goods. It's adding less pressure to the export rates, and we're seeing them fall. There's also one thing that's important here, which is the congestion. So at the ports, we're seeing congestion in May, which is up 44% versus January. So this is increasing the delays for trucks in the area, increasing costs, and then it's also taking capacity out of that, the market on routes between the ports. So it's tightening the market, and it's also adding some upward pressure to the spot market, which we're seeing here. Likely we'll see some more improvements and some added pressure to the import lanes. But we will have to see if we have continued delays and continued supply side pressures from the congestion at ports as well.
Yeah, but good to see how the demand recovery is feeding through. And the next lane is Germany and Czech Republic. Take us through this one, Nathan.
Yeah, sure. So in here, all but one of the markets saw a price rise. If we're looking in Q2, on the head haul, prices rose. Spot prices rose 3.7% quarter-on-quarter, while the contract rates fell 3.4%. So that's on the head haul towards Prague. On the back haul, spot rates rose 7.3% quarter-on-quarter, while contract rose 5.6%. So generally, we've got a much improved environment in Prague for For gross consumer demand, so retail sales are up 4.4%, and non-food sales are up 5.1%. So that's year on year. So good improvement. We're also seeing strong currency performance, lower oil prices, stable inflation, and strong wage growth. So that's facilitated this, especially the consumer side demand in Czechia. And the production, however, is at the moment being quite limited by no new order growth, especially if we're looking at the activity in Germany. So there's less pressure, especially on those import lanes. However, the export lanes and the production is improving. The Czechia, the Czech Automobile Association expects car production to exceed 2019 levels at some point during 2024. So generally increased pressure on export lanes and goods heading out of Prague, but then also on the spot, which is more responsive to that short-term consumer demand. We can expect the economy to continue to improve and add more pressure, but those contract rates that are going to be subject to the performance of Germany industry, like you see on that the import route, it's likely to still head downwards as the pressure remains low, as German exports remain low and German production remains low, and adds less pressure to that lane.
Great, thanks, Nathan. And our last lane we'll move to is actually a domestic rates index, and we've chosen this just to show some of the more recent data actually available through Upply as well. And Thomas is just going to take us through this last lane.
Yes, I will be quite quick on that. We have a full analysis on Italy domestic on the report, so please go into the DLC if you are specifically interested by this country. But very in a quick summary, we can see here. So it's a month-to-month analysis compared to the quarter that we had previously, where we have an index here. We see a drop on the last months, but if we are thinking about the last 3 months, it's quite stable it's stabilizing compared to the past quarters. If we're looking now more at the statistics and the market story that is behind that, something is quite struggling with Italy is that the Italian Statistic Institute shows that the industrial production index is going up, that the demand for consumer goods is going up also over the past in May 2024 compared to the previous months. But the Italian business confidence is not improving, and it's at the lowest points. It's been 7 months in a row that it is decreasing and decreasing. So we have here a situation where our expectation is that, like other countries in Europe, we might see in the following months is an increase in demand that can put a bit more pressure on the demand. I mean, the demand will put a bit more pressure on the capacity and might see the price rising, because it was not the case over the past months. And in Italy, like in France or other countries, we have seen some capacities, and I see some comments in the chat on that, some available capacities on the spots, and the prices were at a quite reasonable level, let's say. Let's see if this will change with a rise in consumer demand.
Thanks, Thomas. Very interesting. So let's then move on to our Q&A session. So thank you to all our panelists for their views and insights so far. But we're now trying to answer some of your questions, and I know quite a few of you have already asked them. So we'll try and deal with as many as we can. So let's take our first question. Yeah, so okay, we've got our first question here asking about transport companies in Eastern Europe having difficulties staying in business, and how do we see that affecting the transport market, especially as supply will be further limited by companies closing down. And Thomas, I can see you want to answer that one, so would you give us your view on that?
Yeah, for sure. I mean, my view is I want to add something, because in the comments, the idea was that more and more transport companies in Eastern Europe are facing difficulties. This is the case also in the western part of Europe. We had some data on Spain, Italy, and France. And if I'm talking about France, the number of transport companies that have been bankrupt over the past months is at a very high level. many answers to that, many ways to explain it. One first is that companies that had some difficulties during the COVID crisis took some loans and now they need to pay it. And for certain companies, this is just not possible. We have seen also low demand with high amount of capacities available in the market. And for sure, for small companies, some of them were facing very high cost with a low demand and were not able to manage that. So this is really a question for the months to come. If we are seeing more and more transport companies that are going bankrupt, and that the demand is spiking again in the following months or quarters, this can put a serious pressure and upward pressure on prices.
Yes, thanks, Thomas. It's a bit of a challenge there. There's actually the next question as well, which is a bit more technical about Upply's coverage, but a good opportunity just to explain your coverage of FTL, but also LTL.
Yeah.
The question is,
the question, yeah, for sure. The question is, we put FTL data, full truckload data here. Can we have a detail on FTL or LTL, less than truckload, and parcels? So we choose here to skip with the FTL because it's the most common use for market analysis, and usually the LTL is following the same trends than FTL. So I cannot go into detail here to say that for sure in certain countries or certain trade lanes, the LTL is a bit different than FTL, but I can say that we choose FTL here because this is the most significant in terms of statistic at the European level. If you want to have LTL analysis, we can have a talk for sure.
Brilliant. All right. Thank you, Thomas, there. Okay, now we've also got a question here on some new regulations, which maybe Romain you could tackle, which is asking, as there are new general safety regulations, GSR, in place starting from July 1st, do you have any information on potential costs for freight transport companies that these new regulations will bring? Do you have a view on that, Romain?
Yes, so the new regulation, it's like new algorithm bringing new sensor and new technology on trucks. So you can expect an increase of truck prices, and especially for new trucks. But for the exact number of the increase, we are working on that and it will be published soon.
Okay, thank you, Romain. And a question, I think, for Nathan, just asking, do you have the total cost of ownership split and operating expenses for transport companies? For example, truck, trailer cost, driver wages, tolls, etc. So you'd like to answer that one, Nathan?
Yeah, please. So good timing because we've actually been working on having a look at this very recently. But I can just give a general answer to that from various sources that we have together. So the biggest contributors to the kind of the cost base for road freight is definitely driver costs, fuel costs, and the cost of vehicle. So to give you kind of a rough estimate, 2023 we had driver costs making up 32% of the cost base, fuel costs making up around 25%, costs of vehicle ownership making 17%. That's then followed by tolls at 11%. So we do have this on the GSCI platform, but just to give you an idea that's kind of how it breaks down. And we have other things like tires around 6%, insurance 2%, maintenance around 6%. And an idea as well, just we've mentioned that rates remain elevated because of the previous cost-based growth. So that cost base has actually grown at 19% if we compare 2023 levels to 2019. With all of them increasing pretty much in line with such wide general price increases across the market.
And I can see this the sort of question kind of following on from those costs, really asking basically what's the trend for rates that you can see out to 2025. So do you have a view on that, Nathan?
Yeah, so again, the cost base is going to remain elevated, but we don't expect the same type of cost pressures. What we are now seeing is that demand is picking up, so that's probably going to be the main driver as we look through to 2025. It's going to be able to push rates up because we're probably looking at a general trend. Demand pressure is likely going to increase as we head into kind of late 2024 and in 2025. We see a more general recovery across the continent. So yeah, we're likely going to head on a gradual increase. That was what we can expect on a larger picture, excluding any short-term unforeseen shocks. The cost base is going to remain elevated, but we don't expect that severe cost pressure we have. And then also, as Romain mentioned, we're going to have this demand growth, but we've got a supply level that is struggling to keep up with that demand growth. So we're going to get into a point where it starts to tighten. And then there's kind of that lack of that spare capacity, which means demand is going to be able to push rates up. So general increase as demand increases, but supply struggles to match that level of increase. And that's kind of, through 2025 and onwards.
Thanks, Nathan. And then one more question for Thomas here. It's on intermodal. How do those developments in road freight rates impact intermodal transport? That's one for you, Thomas.
It's a good question, and I wanted to just comment on that one because I don't have the answer. Sorry for that. We don't see directly the price of intermodal, but what we see is a very high demand for intermodal. And we have a lot of shippers. This is not new. Let's say it's been 2 years or 3 years now that people are looking at intermodal for cost CO2 reductions parts. And taking into account the ETA, the time of arrival, also the cost and everything. But it's been some months now, quarter, let's say, that a lot of shippers are asking and they want to test intermodal for certain type of transportation. The higher will be the rates for road transportation, the more it might be interesting to go in intermodal for the green part, let's say, because intermodal will still have, if we're talking about intermodal rail, for instance, there is still some constraints that are facing this kind of transportation. That's not the case with the rail, with the road.
Thank you. Okay, and this is probably quite a technical question, Thomas, but just another attendee asking, per quarter are the same amount of shipments analyzed for each lane? So
yes, so the answer is that we have a quarter from quarter. It depends on the number of shipments and new clients that are coming to apply. The number of shipments is increasing, so one quarter to the other we have higher number of data, but the analysis is done all the time, everything equal, in the sense that we are looking at a representative truck, and if we have new data that are coming in, we control for this new data to don't have a specific effect due to new big players, for instance, that are coming on the market.
Okay, thank you, Thomas. And can see a couple of other quick questions I can deal with quickly. Will we share a recording after the call? Yes, we will. So you'll get that after this. And another question there, just asking about coverage of sort of UK to France lanes. And we haven't covered those lanes in this particular webinar, but we do quite frequently cover that. And obviously, with the recent developments, looking at new regulations coming in on consignment values and things, and more disruption post Brexit, we probably will cover that in the next lane, and we'll be looking ahead as well to the biometrics coming in later in the year as well, and some of the disruption that may take place from that. So we do, and we'll cover that. And actually, if you go back to previous reports, I know it's not absolutely current, but you'll see lots of coverage on that one as well. Right, I think we're nearly over time for the session overall, but we'll tackle just one more question, I think, just particularly on that question around how tolls are being passed on. I can see, Thomas, you've put your hand up to answer that one as well.
Yes, just wanted to comment on that. Nathan talked about that, Romain also. So there are some insights on the fact that maybe it's just a correlation, but in Germany, the number of bankruptcy in terms of transportation companies is higher since the toll on shippers. And what we see also from the data is that there is no direct pass on from the transport companies to the shippers. Why? I mean, and this is a quick analysis from December to today, up to today. Sorry. So we need more time to know exactly what is the exact pass on. Today, we don't see it directly in the data. It seems that transport companies take a part of this increase and the rest is to shippers, but as the demand was not here, over the past months. The pass on is not 100%. And there are also universities and research centers that are working right now on this analysis. So I think in the following months or quarters, we will have something quite robust in terms of statistics to see the impact.
Thank you very much, Thomas. Yes, very interesting. And so that brings us to the end of our webinar today. So thank you very much, everybody, for joining us. It's always good to have so many attendees, 500 or so, joining us even in the summer. And so all that's really left is to say that if you want to carry on the conversation, you can certainly contact the IRU, Upply, or TI if you want to discuss any of these subjects any further. Obviously, IRU, brilliant for the regulatory questions, and the supply side, apply for rates, of course, and benchmarking, and for transport intelligence. If you want to discuss the future trends and developments for the market, we'll be very happy to talk to you about that. And then I must say thank you very much to my panelists, Thomas, Romain, and Nathan, for joining us, and to you as well. And we'll see you next time. Goodbye.